Hello everyone, and a very warm welcome to this ICAS webinar, which is of course the second of our three-part series of our autumn tax updates. For those that don't know me, my name is David Mingus and I'm Director of Practice here at ICAS, and it's my great pleasure to be hosting this webinar with you today. In this series, we're providing an essential roundup of the most recent tax developments, including of course the important announcements from the budget on the 30th of October. In the first of our series last week, Chris Campbell and Justine Riccomini shared their insight into the changes impacting owner-managed businesses and employers more generally. You are, of course, able to catch up on demand with that if it's of interest to you and you missed it last week. Just go to the ICAS website and search Autumn Tax Update Part 1. But in today's webinar, we are going to concentrate on recent tax developments more generally. So over the course of the next hour, we will look to remind you of some of the other tax areas covered in the budget and related finance bill, as well as some of the tax consultations that are ongoing. And to help explain and understand these issues, I'm delighted that we're going to be joined today by my colleague, Susan Cattell. Susan is our Head of Tax Technical Policy here at ICAS and is a Chartered Tax Advisor. She joined ICAS after a varied career in HMRC in practice and in professional education, and she works closely with the ICAS Tax Board on the direction of ICAS tax policy and represents ICAS and our members on numerous HMRC forums. But before we begin, just a few housekeeping matters to touch upon. Just due to the volume of content that Susan's got to go through, in this webinar, we're not going to have time for a live Q&A section as part of this webinar. However, you can still submit questions through the Q&A facility, which is accessible at the top of your screen. And we will either respond directly to you after the webinar if you include your details, or alternatively include them in an anonymised Q&A document published alongside the recording of this webinar. As mentioned, we are of course recording the webinar and we'll make it available for on-demand viewing afterwards in case you want to refer back to it or share it with others. And as I mentioned, the slides will be available on the events page of the ICAS website under the event listing. Please also join the conversation today through the chat box, which can be accessed at the top of your screen, and this allows you to comment or discuss with fellow attendees on matters covered by this webinar. There is a possibility that for a small number of people on the webinar, neither the Q&A or the chat facility is available. However, this is really as a result of your own organisation policy settings or compatibility with the browser that you're using to join today's webinar. So, as already mentioned, there is a huge amount to get through, so I'll just let Susan get straight into detail of today's webinar. Susan, over to you.
Well, good morning, everybody. Nice to see you virtually, and welcome to the general tax update. And as David said earlier, the just got to be able to move the slides on. Right, as David said earlier, the focus today is going to be on the budget, and quite a few of the budget measures are already in the finance bill, a few aren't. So it's very important to note that anything I say today, quite a lot of it, that some of the detail could change. I'm not expecting core policies to change, but some of the details could. So you need to keep an eye on things as they get put into legislation and it goes through the parliamentary stages to becoming a finance act. Normally I try to cover a few things beyond the budget, but there isn't going to be a lot of time for that today because it was such a huge budget. I am going to mention a few open consultations which ICAS will be looking to respond to, and on the last slide of the day you'll find there will be an email address for the tax mailbox. So if you have any feedback on open consultations or on things like HMRC service levels, then you can always drop us an email. Just to mention that I'm not going to revisit the topics that were covered in the Autumn Tax Update Part 1 because there just simply isn't time to sort of revisit those topics again. So I'm not looking at making tax digital, abolition of furnished holiday lettings, employers' national insurance and the other employment tax measures. I'm also not going to talk about basis period reform because I'm sure most of you who've sort of almost dealt with that by now. But if you do need any help with things like overlap relief and the G form, there's a very good article on the website by my colleague Chris Campbell, so do have a look at that. And we won't also be dealing with devolved taxes because the Scottish budget is not start until 4th of December, and there's an autumn tax update part 3 that's going to look at the Scottish budget and any other devolved tax measures, and that's on the 12th of December. So without further ado, let's get on to 2024, the year of 2 full-blown major budgets. Quite an exciting year if you're in tax. First up, we had the final Conservative budget delivered by Jeremy Hunt on the 6th of March. And the announcements included the abolition of non-dom status, abolition of the furnished holiday lettings regime, and a 2% reduction in employees' national insurance. And the reason for mentioning those three is that all three of them have survived the change of government. And we're going to talk in much more detail about abolition of non-dom status later. And I will touch on the reduction in employees' national insurance. So we had the first Labour budget for 14 years on the 30th of October. And there were several notable things about that, apart from the fact that it was delivered by the first woman to be Chancellor of the Exchequer. It was the first Labour budget for 14 years. The last Labour budget was delivered by Alistair Darling on the 24th of March 2010. The other thing that was notable about it was that it was delivered 117 days after Labour came into government. Now, it's obviously quite common when you have a general election and a change of government to have a budget shortly afterwards. But what was notable here was the amount of time it took to get to that budget. That 117-day wait is the longest wait for a new government to hold its first budget in over 50 years. And the reason I think that's worth mentioning is that it's meant that there was a huge amount of speculation which just grew and grew in the run up to the 30th of October. Now, if you contrast that back with 2010, the last time there was a change of government, I mentioned that Alistair Darling gave the last Labour budget on the 24th of March. Well, George Osborne, who was the incoming Chancellor of the Exchequer for the Conservatives, gave his first budget on the 22nd of June. Very shortly after the May general election and only 90 days after that previous budget speech. And when you look at what happened with the long delay in the run-up to Rachel Reeves' first budget, you can probably see why maybe it's quite a good idea not to have such a long gap, because as a result of all the heated speculation, a lot of people were reported to be doing things like cashing in their pension pots because they were worried that the tax-free lump sum was going to be abolished, or, selling businesses because they thought entrepreneur and business asset disposal relief was going to be abolished, and so on. So it's quite interesting that there was such a long gap, and perhaps it wasn't enormously helpful. Now, another interesting thing is that in its manifesto, Labour had committed not to increase the rates of income tax, national insurance, VAT or corporation tax. And those are the 4 largest revenue-raising taxes. The first 3 of those, between them, raised 2/3 of the revenue, roughly, of government revenues. After that, corporate taxes generally, of which the largest is CT, only raise about 9 to 10%. And anything below that is much less in terms of its contribution to the revenues. So you can see that by making those commitments, Labour had to some extent tied the Chancellor's hands behind her back, because she got very limited options. Now, of course, one way she got round this was by deciding that the national insurance pledge only applied to employees, not employers. So as was covered last week, there was a huge rise in national insurance for employers, but not for employees. So if we have a look at what she did decide to do, let's first of all start with personal tax, because this is where the biggest changes were. So we're going to spend most time on this section before we come on to some other things. So those of you who came to the spring update earlier this year, or indeed the autumn update at the end of last year, will have seen this slide before, because it's not actually changed very much, because the freeze on income tax rates and allowances continues into 25-26. So as you can see, the personal tax allowance remains at 12,570, and the basic and higher rate thresholds are not changing. And from 6th of April 2023, the additional rate threshold was actually reduced to 125,140, and it's remaining at that level. And the thresholds for employees, NICs, remain the same as well, and the income tax rates are unchanged. But the one thing that we did get an announcement on in the budget, so this is the new bit of this slide, the Chancellor decided that from April 2028, when that current freeze ends, those personal tax thresholds will be uprated in line with inflation. Now, there had been a lot of speculation before the budget that she might extend the freeze still further, but she didn't. So there is sort of some light on the horizon, if you like, in terms of those thresholds going up. If we look at national insurance for employees, I mentioned that Jeremy Hunt had reduced the national insurance rates for employees. He did it twice, actually. Autumn statement 2023, he reduced it by 2% from the 6th of January 2024. And then in his last budget, 6th of April 24, sorry, in the spring budget, he reduced the rate again from the 6th of April 2024. Now, there had been speculation that the new Chancellor would reverse that second reduction, or possibly both of them, but that didn't happen. So the rate of national insurance for employees remains at 8% up to the upper earnings limit, and it stays at 2% for earnings above the upper earnings limit. Now, if we look at the self-employed, there were some fairly major changes from April 2024 in that the requirement to pay Class 2 contributions was removed, and it will now be treated as paid for profits above the small profits threshold. That hasn't changed. There was a small tweak to the small profits threshold highlighted in yellow on the slide. It's going to increase slightly to 6,845 for 25-26. The lower threshold is unchanged. Those with profits below that, the 6,845 for 2025-6 may want to pay voluntary Class 2 contributions. Now, those have also gone up slightly. It was £3.45 per week for 24-25. It's going up to £3.50. Class 4 is unchanged. So if we just have a look overall, you may recall that before the election, there was a considerable amount of discussion about no tax increases for working people, and the fact that Labour didn't want to increase taxes for working people. And what's a working person? Does it include somebody who's got any assets, and hence potentially things like dividends from shares? Well, ignoring all the sort of controversy about what is or isn't a working person, let's just have a look at what the Office for Budget Responsibility said in the spring 2024. They said that if you freeze tax allowances and thresholds rather than raising them in line with inflation, which is what would normally happen, then it increases tax receipts, because rising nominal wages tip more workers into paying tax, or it tips them into higher rate bands than would otherwise be the case. And that fiscal drag effect is especially pronounced when inflation is high, as it has been over the last few years. And in the autumn 2024, the OBR updated that to say that the changes to an income tax and NIC thresholds that have been announced since March 2021, so effectively the freeze and that reduction in the additional rate threshold, are going to increase yield by 48 billion in 2029-30. And just to put that into perhaps slightly easier context, as it were, that means that there'll be over 4 million extra taxpayers brought into tax as a result of those threshold freezes from 27-28 onwards, meaning that the number of taxpayers is expected to surpass 40 million. And just to give you a figure to compare that with, when the freezes started in 21-22, there were only 33 million taxpayers. That was the estimate, and it's going to be over 40 million by the time the freezes come to an end. So you can see that, it will be good news when Rachel Reid unfreezes the thresholds, assuming she does do it, in 27 after 2028. So in terms of no tax increases for working people, clearly there has been a tax increase for, well, not just for working people, but for people like pensioners as well, because although they're not impacted by national insurance, they definitely are impacted by the freezes to the thresholds. So it's quite an interesting way of looking at it, I think. So if we now move on to dividends and savings, first up, the rates haven't changed. So again, you will have seen this slide before. The income tax rate on dividends increased by 1.25% from April 2022, and it's remained at that rate ever since. And the rates are fixed for 2025-6 as well. What has considerably changed, though, is the tax-free allowance for dividend income, because some of you will remember that in 2017-18 it was £5,000. It then came down to £2,000. It was reduced from £2,000 to £1,000 from 6th of April 23, and then it was dropped to £500 from 6th of April 24, and it remains at that level for 2025-26. So that's also brought, particularly some, say, pensioners with fairly small amounts of dividend income have been brought into tax, or potentially into slightly higher rate of tax, because that dividend allowance has been reduced so considerably in the last few years. The starting rate limit for savings, by contrast, remains at 5,000. The starting rate for savings is still 0%, hasn't changed, and the personal savings allowances of £500 and £1,000, they're also unchanged. ICAS, there was a huge amount of speculation before the budget that the Chancellor would either get rid of ICAS altogether or reduce the subscription limit or cap them at some lifetime level. And she didn't do any of that. So the normal ICAS subscription limit remains at £20,000 for 2025-26. What she did do, though, was to say that she wasn't going to go ahead with the British ISA, which was something Jeremy Hunt announced in his spring budget 2024. She said she dropped it due to mixed responses to the consultation launched in March 2024. I think really it was just going to add more complexity, and also the proposal was that you would have £5,000 to invest in UK focused assets, so obviously there would also have been a cost to this, so she's decided not to proceed with that. So if we move on, this is the first of the open consultations that I mentioned, really important consultation on simplifying the taxation of offshore interest, published on Budget Day, closes on 22nd of January. We actually had a discussion with HMRC about early 2023 when they were looking at options for it simplifying the taxation of offshore income generally, and this was an area they were particularly interested in. So it's really quite pleasing to see that they've now got this consultation out, because sometimes you talk about things that might help and nothing happens, but here we have actually got a consultation. The reason that offshore interest can be problematic is because a lot of jurisdictions outside the UK do not have, funnily enough, a 5th of April tax year. We're pretty unique in that. Quite a lot of them have a 31st of December calendar year basis for tax. And so if you've got an offshore bank account, you often get your interest reported to you for the 12 months to 31st of December. And that causes problems for individuals filling in their tax returns, but it also causes problems for HMRC because they get reports through the Common Reporting Standard, International Information Exchange, of the interest people have received, and they find it very difficult to match it up to what people have put on their tax returns. So it's fairly challenging all round. The consultation is looking at how we could address those challenges. And one option would be to tax individuals on non-UK tax interest arising in the year ended 31st of December in the tax year. They would put that into their SA return for that tax year. And obviously that does raise some questions, because first of all, you would have to think about taxpayers with accounts in jurisdictions with different year ends, because not everybody has the 31st of December year end. South Africa, it's 31st of March, New Zealand, 28th, 29th of February. I think Australia's the 30th of June. So you would have to think about that. But of course, one option for that would be to say, well, if you're in a jurisdiction that has a 30th of June tax year, then you just take the interest for the year to the 30th of June and report that in the tax year in which it ends. So if it was 30th of June 2024, you'd be reporting it on your tax return for 2024, 2025. The other thing you'd have to think about is whether it should be mandatory or optional. I think it's highly unlikely to be optional. There'd be too much scope for people to manipulate the system by jumping in and out, as it was, if it was beneficial one year and not beneficial in another year. So I think it's likely to be mandatory. One possibility, though, could be that you could stay out altogether if you didn't want to do this. But if you did elect in, then it would be mandatory for any offshore bank accounts that you've got, and you wouldn't be allowed to opt out again. So that's a possibility. There'll have to be a transitional year. There's some quite sensible proposals on that in the consultation. And you'd have to look at the interaction with other tax rules, and particularly to make sure that people couldn't exploit the system, because there are now different rules for UK and offshore interest. So it remains to be seen whether this will be implemented. One piece of feedback I've already had, we discussed this with our private clients committee, is that some foreign wealth managers, investment portfolio managers, do give people a report, and they don't just report the interest that's in the portfolio, but they also report things like dividends and capital gains. So you would have to bear in mind there that it might be slightly confusing if the interest is treated differently. And one of the questions in the consultation is, well, should we look at other things after interest? Interest might just be the starting point. So do have a look at the consultation if you've got clients with offshore income and, interested in views. As I say, the tax mailbox address will be put up later. High income child benefit charge It's not changed. Jeremy Hunt made some changes from the 6th of April 2024. The threshold remains 60,000 as he set it, which is where he set it. And the taper rate, your child benefits only withdrawn once the adjusted net income exceeds 80,000. None of that's changed. What has changed is that Rachel Reeves has scrapped plans to move the HICBIC to a household basis. There was some concern about unfairness because you could have a household with two earners who could earn up to 120,000 before they were affected, whereas a household with a single earner would only earn up to 60. But the government's decided not to do that. Now, there's a plus for that in that there was some concern about how this reflected on independent taxation, because it's very difficult to tax on a household basis, as indeed HICBIC has already shown. But the government's reason for dropping it was actually because of the significant fiscal cost that they thought would be about 1.4 billion by 2029-30. But although they're not moving to a household basis, there is a small improvement to help people get their HICBIC right. The government's going to allow employed individuals to pay their HICBIC through their tax code from 2025 onwards. So that will be quite useful. So moving to capital gains tax. Now, this was an area where there was a huge amount of speculation before the election, and there have been some changes, but not quite perhaps the drastic changes that some people were expecting. First up, the annual exempt amount has not changed. It was 12,300 in 2022-3, so it had already been considerably reduced because it came down to 6,000 in 2023-24 for individuals and 3,000 for trustees, and then 2024-5 and subsequent tax years it was permanently fixed at 3,000 for individuals and personal representatives and 1,500 for most trustees. Now, permanent often means just until the next chancellor comes along, or indeed the same chancellor changes their minds. But in this case, Rachel Reeves has not altered that, probably because cutting it any more would rather defeat the purpose of having an annual exempt amount, which really is to reduce the admin on what really is very small gains. So you don't want people having lots of administrative hassle to file returns for very small gains, which HMRC has then got to administer and deal with, and it's probably just not worth it. So that hasn't come down any further. The previous government reduced the higher rate of CGT for residential property gains from 28% to 24% from 6th of April 24. Quite a surprise at the time, I think. Lots of people thought that was going to go back up. There were certainly reports that people were disposing of properties in order to make sure they got the lower rate. Now, in fact, that was one of the things that didn't actually change. But there were some other significant changes to rates, although the rates were not aligned with income tax rates, so they haven't gone that high. So if we look at what did happen, now, very excitingly, we've got a split year for the first time since 2010. So for rates for gains on assets other than residential property and carried interest, we have a split year with different rates in the period running up to the budget. So that's 6th of April to 29th of October. And then another different rate for the rest of the year, 30th of October to 5th of April. Now, it's important to note, well, let's just look at the rates. It's 10% for the first part of the year, 18% for the second, and if you're a higher rate income taxpayer, it's 20% for the first part of the year and 24% for the second, and next year it will be 18% or 24% for the whole year. The important thing to note about the split year, though, is that the existing provisions under which losses and the annual exempt amount can be used in the most beneficial way will remain in place. So you should still be able to decide, which gain you set the loss against, which is quite important, obviously, in a split where the rates change. The other thing to notice is that there are anti-forestalling rules. So if you've got unconditional but uncompleted contracts that were entered into before 30th of October 24, you need to look very closely at the anti-forestalling rules, because you will need, I'm not going to go into them in detail, but broadly speaking, you're going to have to demonstrate that you didn't enter into that contract with a view to obtaining a tax advantage. So, and there's a few other provisions for connected parties. So you do need to have a look at those if you've got any unconditional contracts. Rates for gains to residential property. This is obviously property not eligible for private residence relief. They didn't change. So everybody thought they would, but they didn't. So there's no split year. They didn't increase. And for high rate taxpayer, it's still 24%. So that was something that didn't actually happen. You'll see I've put the trustees and personal reps rates underneath those two tables. Okay, so if we now move on, I think we do need to just say a quick word about gains on carried interest, because this is another Labour Party pledge, was to change the tax treatment of carried interest, which is the profits of private equity funds paid to individuals as carried interest. Now, that tax treatment's been around for a while, even though I think you could say there was always a case for this being something that really should be subject to income tax, like the profits of a trade. And that was certainly what the Labour Party thought, and they said they were going to change it. Now, what they're doing is in two stages. So you see that for this year, there isn't a split year. Again, we've just got a straight 18% or 28%, depending on whether you're an income tax basic rate or higher rate taxpayer. But next year, the rate's going to go up to 32%, but it will still be treated as a chargeable gain. Now, that's only the first part of a package of reform, though, and from April 2026, carried interest is going to be brought within the income tax framework. But there will be some special rates of income tax for what's called qualifying carried interest. Now, I'm not going to go into the details of this because according to the impact assessment, this only affects just over 3,000 individuals. So, but if you act for one, or if you are one of those individuals, then clearly you need to go and have a look at the proposals for the new rules. I don't think they've been completely finalised yet, the rules for after 25-26. But certainly in the intervening period, to probably get some more money, the rate on charged on capital gains is going up to 32%. Right, of more mainstream interest is the rate on business asset disposal relief and investors relief. Now, again, there was a lot of speculation in business about whether business asset disposal relief would survive. It's possibly not necessarily the best way of encouraging entrepreneurs. And also whether it would change. And the answer is, well, it's certainly survived. We still have it. We still have investors relief. Investors relief, for those of you who haven't come across it, is a lower rate of capital gains tax on the disposal of ordinary shares in an unlisted trading company for external investors. So if you look at that slide, you'll see that there is no split year. It's 10% for the whole of 2024-25. And it's 10% whether you're a higher rate or basic rate income taxpayer. But next year, it's going up to 14%. And for on or after 6th of April 2026, so disposals on or after 6th of April 26, the rate's going up to 18%. Now, there's also, for both investors relief and business asset disposal relief, there are lifetime limits. Now, the business asset disposal relief one wasn't changed. That remains at 1 million. But for investors relief, the lifetime limit's been reduced to 1 million. It was 10 million from 30th of October 2024. And there are some anti-forestalling rules. So there are some anti-forestalling rules for both for business asset disposal relief and investors relief. Firstly, because of the rate change, and secondly, in the case of investors relief, because of the reduction in the lifetime limit. Now, I'm not going to try and go into them because they're quite complicated. This is, after all, anti-avoidance legislation, but you do need to go and have a look, particularly if there are any contracts being entered into from 30th of October 2024 onwards. So do go and have a look at the anti-forestalling rules if that's the case. Moving on, we've got three changes to inheritance tax, three very important changes to inheritance tax. The first one is the extension of the freeze of the nil rate band and the residential nil rate band. Now, this is really important because the nil rate band hasn't actually changed since 2009-10. It's still at 325,000. And the RNRB, which was only introduced in 2017-18, has not increased since it reached 175,000 in 2020-2021. And the taper threshold, i.e. the point at which you start to have RNRB withdrawn, it stayed at 2 million. Now, the previous government said they were going to stay frozen up until 2027-28, but Rachel Reeves has actually said she's going to freeze it for a further 2 years until 5th of April 2020-30. And the Office for Budget Responsibility suggests that that extension to the freeze, combined with the other two changes to inheritance tax, which we're going to look at in a minute, will raise 2.3 billion by 2029-30, but notes that that's highly uncertain because clearly people can do a lot of planning around inheritance tax. And the interesting thing is that Rachel Reeves didn't put a stop to some of that planning. So, for example, she didn't do anything about pets potentially exempt transfer. She didn't change the length of time you have to stay alive after you've made a pet in order for it to become completely exempt. She didn't change things like gifts out of income, which she could have done. So there are still quite a lot of planning opportunities. So that's why the money these changes will raise is not completely certain. It's worth noting as well, though, that the change to employer NICs is expected to raise over 20 billion a year. So the fact that this is only going to produce something like 2.3 billion, obviously it doesn't come in, and it's not all of it comes in immediately. But I mean, it does give you an idea of the scale of the difference, and probably gives you an idea why Rachel Reeves had to increase employers NIC, because she needed to raise some serious money. So if we look at the other, the second of the three changes, and this is the one that's had an awful lot of publicity. You've no doubt seen all the reports in the press and on the television, and people taking their tractors to Whitehall. This is agricultural property relief and business property relief. Up until the budget, it was 100% relief, and there was no cap on that. But for deaths or lifetime gifts from the 6th of April 2026, there's going to be a cap on the amount that can qualify for the 100% relief. You'll be able to get 100% relief for the first 1 million of combined agricultural and business property, but above 1 million, the rate of relief will only be 50%. The rate will also be 50% in all circumstances. So there's no 1 million threshold here for shares designated as not listed on the markets of recognised stock exchanges such as AIM. And that's really aimed at, there are quite a few wealth managers who will sell you products that invest in AIM shares specifically to reduce your inheritance tax liability. And the summary of the changes was published on budget day. Now, no, we don't have any draft legislation or anything. This could certainly change, although Rachel Reeves and the Keir Starmer have been saying they are not going to change the core policy, but the details could certainly change. There's going to be a technical consultation in early 2025, which will focus on the detailed application of the allowance to lifetime transfers into trusts and charges on trust property. Now, I think it's really important to note that obviously the farmers have had a huge amount of publicity, but this also affects family businesses in other sectors. So, any family business. I've seen recent reports, for example, that there are apparently a lot of family businesses running coaches, companies providing coaches, and similarly family companies running historic properties as wedding venues. I've seen reports on both of those. So it's really important to note this isn't just about farmers. Let's have a quick look at the details, some of the details published on budget day, the key features, and I say do bear in mind that some of the detail could change. The allowance it will apply to the combined value of property in the estate qualifying for BPR and 100% BPR and 100% APR. And if the total value of the qualifying if the total value of the qualifying property to which 100% relief applies is more than 1 million, the allowance is applied proportionately across the qualifying property. And it looks as if you won't have any choice about that apportionment. So if, for example, you've got 3 million of agricultural property and business property of 2 million, the allowance for the agricultural property will be 600,000, and for the business property, it will be 400,000. Assets automatically receiving 50% relief will not use up the allowance, so your AIM shares, for example, will be separate. Any unused allowance will not be transferable between spouses and civil partners, and that's really important because obviously a lot of people, if they're looking at estate planning, will have possibly not decided to change the split of ownership between spouses and civil partners because they were just saying, well, it doesn't matter, we're going to get 100% relief anyway. So that's something that's going to become much more important unless that is changed, of course. Where the rate of relief for agricultural business property is at 50%, so for example, if you've got quoted shares in a company giving the transfer or control, the rate of relief will not be affected by the new allowance. And it's also really worth noting that inheritance tax on business and agricultural assets can be paid by instalments, interest-free, over 10 years. So that's quite an important thing to note. Now, I'm not going to get into, there's been an awful lot of debate about how many farms are actually going to be affected, you know, with the government saying one thing, or in fact, two different government departments, I think, saying different things, and farmers and saying other things. I think the really important thing from this, and I went to a 1.5 hour presentation from a lawyer who specialises in capital taxes the other week. I think the really important thing is for businesses and farms to take note of the fact that these changes have happened and to get some advice, because as I said earlier, there's still lots of scope for planning, but the assumptions on which that planning is based, you know, they will be changing in effect. And one thing that the speaker said that I thought was really interesting was that, you know, it's not a question of just getting a bit of tax advice. You probably need some legal advice, because you need to look at things like how the property is held, you know, what happens if, say, you bring in family members and then one of them has a divorce, you know, there's asset protection issues, there's all sorts of issues. So it's worth people taking some proper advice from tax specialists, from a lawyer, and also, and particularly if the next inheritance tax change is relevant, also from a financial or wealth planner, because the next inheritance tax change is to do with unused pension funds and death benefits payable from a pension, because they from 6th of April 2027, they're going to be brought into a person's estate for IHT purposes. So pension scheme administrators are going to become liable for reporting and paying any inheritance tax due. Now that makes sense, because the pension scheme administrators are people with access to the money, because ultimately they will be paying it out to the beneficiaries. Personal representatives, of course, won't have access to the money. So that's quite important. And we'll look at the practical consequences of that in a minute, though. But I think it's important to note that what the government said about this is that this will restore the principle that pensions should not be a vehicle for the accumulation of capital sums for the purposes of inheritance, as was the case prior to the 2015 pensions reforms. Because, of course, if you look back in time, the whole point about a pension fund was that you had to go and buy an annuity. It was about funding your retirement. And then the big reforms to pensions gave this possibility of pensions being used for, you know, to hand on wealth to people, to your beneficiaries. So you can see why the government is saying, well, actually, we want to turn the clock back. And the trouble is, of course, that people have gone and planned on the basis, you know, on the assumption that was going to be the way it was going to stay. That's the trouble with things like pensions. They're a long-term commitment. Now, there is going to be a technical consultation on how to do this liability reporting and payment, because I said, you know, it makes sense for the pension scheme administrators to be doing the payment. The problem, though, is that the PSAs will have to liaise with the personal representatives. The personal representatives will have to tell the pension scheme administrator that somebody's died. They'll have to get details of all the pension pots from the PSAs, and then they will also have to allocate the nil rate bands to those different pension pots and tell the PSAs what that's going to be. Apparently, the government's going to put a calculator on the website to do that. Now, you can see, given that inheritance tax has to be paid 6 months after the death, you can see that this is going to be a very tight timescale. There'll have to be deadlines, there'll have to be requirements, and I've certainly had a couple of lawyers have already said to me this is going to be really practically difficult, particularly because you might put in a figure at 6 months and then things could change, and you might, you know, perhaps you might even need to change the allocation of the nil rate band, or perhaps in fact what you just say is, well, once that's been done, as far as the pension pots are concerned, that's it, because, you know, the pension funds will need to get on and pay out to the beneficiaries and so on. So there's lots and lots of issues there. So if you're in any way involved in inheritance tax and estates, it's worth going and having a look at this consultation. We are looking at doing a response on the practicalities. So do go and have a look at that. Any thoughts, do send us an email. Right. couple of other things on inheritance, and obviously nowhere near as big, but first, a piece of good news: the government is going to spend £52 million digitalising the inheritance tax service from 27-28 to provide a modern, easy to use system, making returns and paying tax simpler and quicker. Well, now, large government IT projects, I'm sure we could all speculate on whether it's really going to be an easy to use system. I'm sure there'll be some teething problems, but overall, this is good news, because if you remember, during the pandemic, HMRC was letting people use Dropbox for inheritance tax, and that was really popular. The problem, of course, with that was that after the pandemic, HMRC decided it wasn't secure enough, so a lot of it's gone back to being done on paper. So there's a lot of support from people I've spoken to for having it digitalised. That would be a good thing. But you know, it's obviously going to take a bit of time, but at least the money has been provided to do it. The other piece of good news, which we don't need to spend a lot of time on because this has already been announced, previous government said that they would extend the scope of agricultural property relief to environmental land management from 6th of April 2025. And Rachel Reeves is going ahead with that. The relief will be available if the land is managed under an environmental agreement with or on behalf of the UK government, devolved governments, public bodies, local authorities, or approved responsible bodies. So good news, that's going ahead. And obviously that fits very well with the net zero agenda. It didn't make much sense for those things to be excluded from APR. Right, reform of the non-UK domicile tax rules. Now, if any of you came to the spring update, do forget everything that I said then, because that was the proposals of the previous government. Now, although, as I said at the beginning, Rachel Reeves has decided to proceed with the reform of the non-UK domicile rules, not really surprising because it was a Labour, you know, it was a long-standing Labour policy, which you could say Jeremy Hunt perhaps stole from them. They have changed some of the detail. Now, we haven't got time to obviously look in huge detail at this, but I did just want to highlight some key features that are going to be in play from 6th of April 2025, subject, of course, to any change as this works its way through Parliament and becomes the Finance Act. So for people who are coming to the UK, so new arrivals in the UK, and new arrivals is people who've had 10 consecutive years of non-residence, there's quite an interesting, a favourable regime, the 4-year FIG regime, as it's called, foreign income and gains. And if you claim the 4-year FIG regime, you won't pay tax on FIG arising in those 4 years. Now, it does exclude foreign employment income, but that's because the overseas workday relief will still apply to that. That's continuing, and it's been expanded. It will now be for a 4-year period, still based on the amount of time spent overseas and the income relating to overseas duties. From 6th of April 2025, the eligibility is primarily based on whether employees are eligible for the 4-year FIG regime. There will be some transitional rules for people who were already claiming OWR. And there's going to be an annual limit, lower of 30% of net employment income or £300,000 per qualifying year. Now, for existing non-DOMs, the protections for trusts settled by non-UK domiciled individuals, that's going to be removed. That's not a surprise. Labour said that was going to happen. I'm not going to try and go into any details about that because it's simply too complicated. But if you've got clients affected, obviously you will need to go and look at that. I'm also not going to go into detail on the temporary repatriation facility, which is a 3-year window to allow individuals and some trust beneficiaries that have claimed the remittance basis in the past to pay a lower rate of tax on their unremitted FIG. And obviously, the aim of that is to try and get them to stay and to bring some money into the UK. A couple of other things to mention. There will be CGT rebasing for the personally held assets of non-UK domiciled individuals. So that's if you're a current or past remittance basis user, you can rebase personally held foreign assets to 5th of April 2017. Now, there are various conditions which are set out on the slide around you mustn't have been UK domiciled or deemed UK domiciled. You must have made a remittance basis claim in those specified years. You must hold the resident asset on 5th of April 17 and dispose of it after 6th of April 2025. It must have been situated outside of the UK from 6th of March 24 to 5th of April 25. There are a few exemptions to that, including temporary importation. So that's quite good. I mean, you may remember, some of you, that the rebasing date under the previous government was going to be a date in 2019, and there was some representations on that, so it's changed to April 17. And finally, the new government is taking forward the move to a residence-based regime for inheritance tax. The previous government was going to hold a formal consultation. That's no longer going to be the case. But we did discuss the proposals with our private client committee, and we gave some input at a listening session, which was held with HMRC to talk about the detail. UK assets remain in scope, which is no change. Whether non-UK assets are in scope is going to depend whether an individual is a long-term resident, i.e. resident in the UK for 10 of the 20 years prior to the tax year in which the chargeable event arises. And that means that back in the spring, we were thinking there would be a 10-year tail for all of those assets, i.e. they would remain within the scope of UK inheritance tax for 10 years after you left the UK. The way it's been tweaked, they'll remain in scope for between 3 and 10 years after leaving the UK. There are some transitional rules for those who are non-resident in 25-26 and don't come back. And again, there are changes to settlements and excluded property. So that's a very quick whiz through the rules. Obviously, there's lots of detail. You may recall back in the spring, if you attended the session then, that I mentioned some of the newspaper headlines about petrified non-DOMs poised to flee over Labour's tax plans. It's interesting to look. The OBR's had a look at, the Office of Budget Responsibilities had a look, and they've slightly increased their migration forecasts for non-DOMs compared to March. They now think about 12% of non-DOMs without trusts will leave, and about 25% with trusts will leave, and that's partly because all the trust protections have been removed. Compared to in spring, they thought it was going to be 10 and 20%, but they do point out that's really, really uncertain. We don't really know how many people will actually leave as a result of this policy. It remains to be seen. Right, so now let's move on to business taxes for the last 15 or 20 minutes of the presentation. So it's been quite a quiet budget for business taxes. Bit of stability, really, which is, probably quite good for businesses in some ways, if you ignore the change to employers' national insurance. Right, so the CT main rate, corporation tax main rate, stays at 25%, and the small profits rate stays at 19%. There's also no change to the marginal relief thresholds. There's also no change to full expensing. It had been due to end in March 2026, but it was made permanent by the previous government, and the current government hasn't changed that. And they've also said they will explore extending full expensing to assets bought for leasing or hiring when fiscal conditions allow. Now, effectively, the previous government was also looking at doing that extension, and there has actually been a working party, which ICAS belongs to. So it remains to be seen, when fiscal conditions, or if fiscal conditions will allow, we shall see. Annual investment allowance remains 1 million, and there has been a 1-year extension to March or April 2026 for first-year allowances for qualifying expenditure on zero-emission cars and electric vehicle charge points. One thing that hasn't changed is any of the conditions for full expensing. I think some people were hoping that it might have been made a bit more liberal, but that hasn't happened. So the other sort of big announcement, if you like, on budget day in the corporate tax space was the corporate tax roadmap. Now, before, in their pledges ahead of the general election, Labour had promised a roadmap for business taxation for the next parliament to allow businesses to plan investments with confidence. But somewhere between the election and the budget, that morphed into being this corporate tax roadmap. Not quite sure why. There was some speculation that it changed when they had the big investment summit just before the budget, but I don't know. Now, the key commitments in the corporate tax roadmap, and these are only the key commitments, there are some others, but if we group them, they're going to cap corporation tax at 25%, the headline rate. They're going to keep an eye on international developments to make sure that the UK's regime remains competitive. So maybe there's a bit of scope there to reduce that headline rate, perhaps, who knows. And they're going to keep the small profits rate and marginal relief rates the same for the current parliament. They're going to maintain permanent full expensing for this Parliament. They're also going to maintain core features of the capital allowances regime, including the 1 million AIA writing down allowances and structures and buildings allowances. They're going to maintain the generosity of the rates for the merged R&D expenditure credit scheme, and they're going to enhance the administration of R&D reliefs, including improving guidance. And they're also going to publish an update in spring 2025 on modernising the technology that the CT system relies on, which is quite old. And just one other thing to mention here, because I couldn't fit it in anywhere else, it wasn't actually in the roadmap, but there's going to be a consultation on e-invoicing at some point in the not too distant future. So that's quite largely relevant to VAT, really, but it shows the direction of travel in terms of technology. And also in the technology field, HMRC is going to publish a digital roadmap in early 2025, showing how they're going to improve and their systems. So those are two more things to watch out for. Now, the corporate tax roadmap also promised that there would be consultations on the following. Firstly, before the end of this year, we're going to have a consultation on the tax treatment of pre-development costs. And the roadmap notes that this arises from business concerns following the Gunfleet Sands case. If anybody's not come across Gunfleet Sands, this was a case of somebody wanting to build a wind farm, and they incurred expenditure of about £48 million on environmental and technical studies in preparation for building the wind farm, and only to discover that they weren't a deductible revenue deduction because they were capital, but they also didn't qualify for capital allowances. So that's caused loads of uncertainty. It's obviously not good news if you want people to build wind farms, net zero agenda. So I was at a round table earlier this year with the Treasury and HMRC talking about uncertainty in the capital allowances system. This is something that's been raised with us, and it was obviously raised with other people as well. So it was one of the things that was mentioned, and it's obviously quite good to see that we're going to have a consultation on looking at that. Spring 2025, we're going to have a consultation on land remediation relief. Probably of more mainstream interest, there's going to be another consultation on reforms to transfer pricing, permanent establishments and diverted profits tax, including the potential removal of UK to UK transfer pricing. That's sort of potentially good news, but on the slightly less good news side, there's going to be a consultation on potentially lowering the thresholds for exemption from transfer pricing. So some smaller businesses are looking at that and thinking, that probably isn't quite so good, but we'll have to see what the consultations say when they appear. There's also going to be a consultation on a new process that will give investors in major projects increased advance certainty. Now, obviously, that's also, if you like, in a way linked to the whole Gunfleet Sands issue. If you're going to put money into a big project, you really want to know whether you're going to qualify for relevant tax reliefs. So the only possible hitch there is that I think a lot of people would like to see it not confined to major projects, but to smaller ones as well, because people want certainty if they're going to invest. Oh, sorry, I've just jumped on too quickly. There's also going to be a consultation on widening the use of advanced clearances for R&D reliefs. At the moment, there's a very restricted scheme that largely relates to small companies who are about to claim for the first time. So that's going to get wider. Right, VAT. Very quiet year on VAT again. The VAT threshold. Now, you'll remember that the VAT threshold had been 85,000 since April 2017. And as highlighted on the slide, that was causing lots of problems because businesses deliberately sort of shut up shop for the summer to keep their takings below 85,000 because they don't want to get into the VAT system. So there's been some suggestions for some time that it might be worth revisiting this. And if you look on the website, I posted an article around the time of the spring budget setting out all the arguments about, should we increase the threshold by a lot or reduce it by a lot? And it was quite disappointing that Rachel Reeves hasn't grasped that nettle, because what happened basically was that the previous government increased the VAT threshold to £90,000 from 1st of April to 2024. And Rachel Reeves has not changed that. And she obviously hasn't changed the deregistration threshold either. So that's something, and I don't think an increase in £5,000 is really going to have much impact on that bunching problem, particularly given the inflation we've had. So, that's a nettle that has yet to be grasped. So we'll have to see if she picks it up later. The other thing that has happened, of course, Labour pledge was to introduce VAT on private school fees. And Unsurprisingly, that was confirmed in the King's speech. There was a technical consultation at the end of July, and the ICAS response focused on suggestions for what HMRC could usefully put in guidance, because, of course, this is a big change to VAT. And a lot of the people who are affected by it will not have had any experience with the VAT system, because unless they had a trading subsidiary, they probably hadn't had to deal with any VAT. And there are also some complex issues because this is such a big change. If you look at what's going to happen from 1st of January 25, fees charged for education services and vocational training and closely related boarding fees will be subject to VAT at the standard rate. But the provision of other services closely related to education remain exempt. So that's things like books or meals or buses to school. Now, the problem with that, of course, is that you could see, first of all, you might want to start saying, well, we'll allocate more money to the to the exempt services. And obviously HMRC will be looking out for that, because value shifting is not allowed. But it also raises complex issues if you've got a bundle of supply. So is it a single supply or a mixed supply, and so on? So that's why you need guidance. And nurseries remain exempt. HMRC did publish some guidance. When it initially came out, it was really, really disappointing. Lots of gaps. It wasn't terribly helpful. It's been improved a bit since, but I think there'll still be a lot of schools out there looking for advice. So if if you're in the field of VAT, you've probably already been asked for some help on this. So that's the main things on VAT. As I mentioned earlier, there is going to be a consultation on e-invoicing, but we don't have it yet. Right, two more things to mention. We've got just under 10 minutes left. So tax administration, if you came to the spring update, you'll know that there was a call for evidence that was open at the time of the spring update on proposals to reform inquiry and assessment powers, penalties and safeguards. Really significant, big, wide-ranging consultation. We submitted a response, and the government has published its response on Budget Day. And there will now be further consultations in 3 areas. We don't have time to go through all those, but I do just want to highlight the one that has already been published and is currently open. Consultation on new ways to tackle non-compliance. A bit disappointing that they picked this, out of all the things that were in the consultation document, this is the one they're doing first, but there you go. This is all looking at, well, as it says, putting more responsibilities onto the taxpayer, shall we say. It's open now, closes on the 22nd of January. The proposals include the reform of revenue correction notices, so that taxpayers have to provide evidence if they reject an HMRC correction notice. There's also the option of providing more information up front for some claims. And that actually, having discussed that with our private client committee, that could actually be quite helpful in some cases, because it might prevent HMRC issuing a correction notice to say, no, that you can't have that relief, or it might prevent them opening an inquiry. So that's an interesting proposal. This one's also interesting. Introduction of a partial inquiry into a specific issue or section of a return. Now, that could also be helpful in certain circumstances, as long as it doesn't suffer from mission creep, because one of the proposals is that HMRC would have time limits for responding when you've sent them information. And the third one, and so far I haven't managed to find anybody who thinks this is a good idea, HMRC would be able to tell taxpayers to self-correct their returns, which just seems to add another layer of bureaucracy and complexity. So I'm not so sure that one's such a good idea. Right, raising standards. Again, some of you will remember from the spring, this is a programme of work, raising standards in the tax advice market, that started in 2020. There have been a few consultations and there have been some actions against repayment agents since this work started. But the really big consultation came out in the spring budget 2024. We covered it in the spring tax update earlier this year. It was proposing 2 things. Firstly, that all agents interacting with HMRC on behalf of clients should be required to register with HMRC. You might have thought that they already had to, but they don't, as that happens. And the second one, the really big proposal, was we should actually regulate the tax advice market, because currently anybody can just set themselves up and say, I'm a tax advisor. There's no regulation at all. And the possible options for regulating the market were mandatory professional body membership, which was supported by ICAS and the other main professional bodies, joint HMRC industry enforcement, a sort of hybrid model, or regulation by a government body. ICAS responded. We were also part of a joint high-level response by the 7 bodies who sign up to professional conduct in relation to tax. And a response was published with the budget. What's going to happen is that but they are going to go ahead with the proposal that agents have to register with HMRC from April 2026. HMRC will be improving its agent registration system to do that. But don't misunderstand this. That doesn't mean HMRC will be regulating those people. It's just that they will have to register to use HMRC services, not about regulation. Tax practitioners submitting income tax repayment claims on behalf of clients will have to obtain an advanced electronic signature, and there will be a consultation shortly on options for stronger sanctions against practitioners who enable clients to pay the wrong amount of tax. But what was really disappointing is that there was no decision on regulation itself. The government's going to take on board the opinions shared in the consultation, which I should add mean that over 60% of responses supported option 1, mandatory membership of a professional body. But the government's going to look at the opinions and will continue to work closely with the sector to consider options to strengthen the regulatory framework. So it's very disappointing, but hopefully all the work that's gone into this won't be wasted. I think part of the problem was that the Exchequer Secretary for the Treasury, who's now responsible for HMRC, just really hasn't had a lot of time in office, so probably wants to take a further look at this. And we've had an initial meeting with HMRC, and there are more meetings and discussions forecast, so we should get a clearer idea of what's going to happen. Right, so that's the substantive part of the presentation. We've got 3 minutes left. And I just wanted to remind you that the ICAS tax team, we take up issues that you report to us. So, problems with HMRC services, problems with HMRC systems, we take them to the relevant stakeholder groups. We use the Agent Online Forum. We've taken a lot of feedback to HMRC about the ADL this year, and you may have seen I posted an article not that long ago. As a result of all the feedback from ICAS and other professional bodies, HMRC did make some improvements from the beginning of October. So we're also a member of the Charter Stakeholder Group. Some of you may have filled in the survey earlier in the year, the results of which informed the CSG contribution to HMRC's annual report on how it's performing against the Charter standards, which I'm afraid wasn't very good. Again, if you look on the website, there's an article about the annual report published on 30th of July. We also send letters to ministers and to senior HMRC people. We have meetings. So there have been 2 meetings with the new Exchequer Secretary since July, one of which was quite interesting because we discussed our priorities for improving the tax system. Not surprisingly, we and other people were talking about improving HMRC service levels. There was also a letter to the XST in July about making tax digital. If you want to send us some feedback, and I've mentioned this several times in the course of the presentation, there is a tax mailbox. Send us your feedback on open consultations or indeed on problems with HMRC services. You can sign up to the Agent Online Forum. You can use the HMRC dashboard for agents, which is something that the professional bodies have been asking for and which does now exist. Tell us about problems with guidance. HMRC do look at and act on feedback that's given to them about their guidance, particularly their manuals, because they have control over their manuals, whereas if it's gov.uk content, they have to abide by government digital service rules. Charter do complete the annual survey that the Charter Stakeholder Group puts out. And if you think you might like to join an ICAS tax committee, I've mentioned the Private Client Committee a couple of times today, do look out for advertised vacancies on the ICAS website. If there's any one big problem you're encountering at the moment, put it in the Q&A or drop us an email after this session. So, hope that was a useful 1-hour rush through some of the key points in the budget, and look forward to seeing you virtually at the next update, which will probably be in the spring.
Excellent. Thank you very much, Susan. A very big roundup of everything that's happened today. Well, as I say, we are almost out of time. Thank you for everyone for joining the webinar today. As we are starting to draw this webinar to a close, it would be great if you could leave us with a rating for today's webinar. There should be a poll that will either appear on your screen or in the chat box, and we do appreciate your feedback. While you're doing that, just a reminder that you can keep up to date with all the latest information on tax and other professional news, including the latest guides and resources on ICAS.com. And just looking ahead, we do have a range of events in the weeks ahead, which you might wish to sign up for. You can join us again on the 12th of December, as Susan mentioned earlier on, which is shortly after the Scottish Budget being held on the 4th of December, when Justine Ricomini, our Head of Devolved Taxes, will be back with the final part of our autumn tax update, and we take a look at developments in relation to those devolved taxes. And if you happen to be in or around the south of England, you may also be interested in signing up for an event being hosted by HMRC in their Croydon building on the 5th of December, when they are hosting an event bringing together agents and software developers to help you get ready for MTD for ITSA when it becomes a legal requirement from April 2026. Links to sign up to all these ICAS events are available at icas.com/events. It does only leave me to thank you for joining us today. As I say, lots of questions around the slides. They will be available together with the recording, again, also at icas.com/events. But until the next time, goodbye.